Hi, I'm Roshan Kanasan and this is Ringgit Bytes. Growth and work-from-home stocks have dominated investor interest over the past year, but we shouldn't forget dividend stocks, which could still offer good returns, especially with interest rates so low. That said though, not all dividend stocks are created equal. So today we sit down with fund manager Danny Wong, CEO of Areca Capital, to discuss dividend-paying stocks, otherwise known as yield stocks, and the risks involved.
Yield stock is typically a company that pays dividend regularly with their sustainable earnings and cash flow. First thing first, actually looking at the yield of the stock itself, that means dividend yield. It's actually a dividend payout over the price that the person pay. The person should consider whether the dividend payment is sustainable, whether the type of company can last longer in paying this dividend, and looking into the company's trend and the industry, for example, and also look into some metrics, for example, whether the company has debt. Usually we look at the business, whether the business actually sustain in future and they're able to generate cash flow. So when the cash flow coming in, then it's actually the company policy to pay certain earnings to investors as a form of reward. Conventionally, yield stock pays most of the earnings or cash to investors. It also means that left with very small portion of the earnings to grow the company in future. It may compromise the future of the business. And on top of that, there are companies that actually earns profit but with the cash flow to be delivered later. So some of the companies actually rely on borrowings to fund the dividend, and this company you got to be a little bit of careful. Dividend yield, by definition, is actually a function of dividend payout over the price. Dividend yields can be increased because of higher payout. It also can be increased because of denominator coming down. That means the stock price come down. And someone tends to be attracted by this without having understand about the stock, and end up you are buying an underperforming stock in long run by judging today's dividend yield. For instance, print media companies, if they continue to pay high dividend because of the earnings or because of advertisement, but in future this income could be affected because of the digital media and whatnot. If the company do not really diversify into other business, then there will be a trap of current high dividend yield, but future business could be compromised.
Do you have any money or personal finance questions? Well, you can drop them down in the comments below or email us over at ringgit@bfm.my.